Okay, everybody, welcome. This is our quarterly market update, specifically for our clients. We do a lot of content from the podcast to webinars and different things. This today is specifically for clients whom we love working with. And so we wanted to just kind of dive into some of the things that have been top of mind for us over this past quarter. Obviously, my name is Jake here. We have Lauren, Rabih with us. How are you guys doing?
Doing
Good.
good.
How are you?
Good. I'm doing great. I'm excited to be here with you guys. So technically this is Q2 market update. We're recording this into Q3, but doing a recap of Q2. If you listened to some of these before, you probably know the flow of how these go. We will start with some company announcements, things that you need to be aware of that we are kind of promoting or doing as a company. We will get into some things that have been top of mind, some questions that we get from clients often. I think today we're going to focus on student loans is a big one. Trump accounts is another one I've been getting a lot of questions about. Lauren, have you been getting a lot of questions about those things?
The Trump account's not as much,
Okay.
but not a lot of my clients are having kids either, so I feel like it hasn't been on the mind as much.
Well, that's fine.
But
I've
the
had a
student
ton
loans,
of
yes.
Okay, student loans, yes. So I've had a ton of Trump account questions, actually. It's just kind of like, I feel like it's a new, exciting account. Rabih, we get so used to 401ks and IRAs and kind of the same accounts. Like, oh, a new account that's opened up. Is this thing special? Yeah. Will it make me wealthy beyond my wildest dreams if I open up this one account? We will get into it. So Trump account, student loans will be some big topics. And then Rabih, we have our investment guru here who will talk about just kind of stock market updates and other economic updates towards the end as well. Anything else, guys? Comments or thoughts before we dive in here?
Look how fancy Robbie looks in that. You look like you're like commanding a room in there. You know what you're talking about.
I don't think I've seen this picture before. Like, I know we got some pictures from the summit. I don't think I've seen this one before.
Both of these pictures are from the summit that we had in Q2, right back in June, which is a lot of fun. Thanks, if people are listening to this who went to the summit, we're glad you came. We had an awesome time. So yeah, Rabih had a presentation there that was awesome. This is our company photo here in the pink shirts. Okay, good time here. Let's jump in. I am directing the slides here. For those listening to, we'll try and keep this maybe half an hour, right? Yeah. We may not go super long here. We'll try and be succinct as we can, as much as I can be succinct. Okay, let's see if I can get this to work.
15 minutes if you watch on 2x speed.
15. Are you at 2x? Do you guys do 2x podcast speed? Is that you, Rabih?
If I can go higher, I would.
Yeah, if I can go higher, I would. It's my favorite thing when I put it to like the regular speed and I'm like, they sound dumb.
Crazy. I am not. I am a huge podcast listener. I don't do 2 times. Sometimes I'll do 1.5, maybe if it's like a podcast I'm not really interested in, but I just need to know the information. I will just go through it. 2x is wild. Good for you guys. Okay. Well, I'm trying to click through to the next slide here and nothing is happening. Let me try something. Maybe if I do this, here we go. Okay, company announcements, as we promised that we will start with here. Dentist Money Launchpad. For those who do not know, this is our new program we've run out. We did one at the beginning of this year where essentially we are doing I don't know, what's the best way to describe this? Like a school program is kind of what we're basing this off of. Like everything you didn't learn about money in school, we want to teach you here through this 8-week course. We hit on a bunch of different topics from insurance to student loans to investment basics to budget planning. Every week there's a different teacher. I'm on there one week. Rabih's on there. Lauren is on there. I thought this went really well when we did this at the beginning of the year. We are essentially just revamping it for the fall. So we're starting September 17th, which should be a Thursday. Yeah. Yes.
For associates, if you have associates that are just getting out of school, any of your children that are going to dental school, I feel like it's a good opportunity for you to get some good education for people in your lives.
Exactly. If there's any younger dentists that like exactly like you said, Lauren, associates, somebody else who just wants to kind of get some financial planning basics, this is an awesome program. Highly recommend it. So you can use that QR code to kind of save your spot or send out to anybody. Again, there's CE credits and things involved.
Yeah, I think there's 3 CE credits. I looked at it today.
Okay, great. Perfect. Okay, Dentist Money Launchpad. It's awesome. Other announcement here is we essentially just want to get out and meet with our clients and meet with other dentists and host as many events as we can. So if you or somebody if you are in a study club or if you know of a study club, we would love to fly out and present there.
Especially in Hawaii, right?
Yes. If you live in Hawaii, we have a few clients in Hawaii. You know who you are. If you live in a warm place, especially during the winter here in Utah, if you live somewhere warm that we can come out and visit you, we would prefer that. Yes. So essentially, we just want to come, like we are, as you all know, we lead with education. We love education. We do a ton of content. We just want to extend that here. And if you are part of a study club, as I said, no study clubs, or even like not a study club, but you just get together with other dentist friends on certain occasions, we would love to come and present. We can tailor our presentations to anything that you want, really, right? We can do investment basics, just like finances 101, cash flow, transitions, retirement, practice stuff. Like we would like to customize this to whatever you or your group is interested in. If this is something that you think would be awesome, you can just let us know. Reach out to your advisor. That's probably the best way to do it. Just reach out to your advisor and we can kind of put you in the right direction, get you with our marketing and content team and set that up. Lauren, anything to add there? Did I hit it?
No, I love doing these. They're so much fun. It's always fun. To go to a new place, see your city that you're in, and take you out to dinner. I'm sure.
Yes, we'll have a good time. And as you know us, we are not doing these like we're not super salesy people where we're going to come in here and try and grill your friends to sign up with us. We just want to come out. It's essentially just to get our name out there, get our brand out there, try and give you valuable information, and that's about it.
Yeah, we promise we won't corner your friends.
Yes, we will not. Okay, so study clubs, let your advisor know or message somebody you have a contact with the dentist advisors if that's interesting to you. I think this is our final announcement here. As some of you may or may not know, we partnered with an accounting group a couple of months back. They're called Edge Advisors. We're now offering in-house accounting services, which is huge. We got questions about this for years of people like, hey, I love your financial planning. This is great. I know we kind of have to communicate back and forth with my accountant. Is there any way that you guys offer accounting services or can we bring that all together in one place? We've started doing that now. So if you're dissatisfied with your accountant or looking for someone just to review your taxes or anything there, we now have CPAs that can work specifically for you. Let us know about that. Again, we're offering free, what we call a 5-point tax review, where the tax team will just take a look at your tax situation, see where you're at, if there's anything that needs to be improved, set up a consultation about that. Is awesome. Anything I'm missing there, Rabih, Lauren? Good there on the tax side of things?
I think you're just crushing it. You're getting through it.
Okay, we're going through. I am going through quickly here. I feel like I'm talking fast, which is not new for me. Okay, so tax services, again, that's another thing. Just if you're wanting to know more about this, contact your advisor or anyone at Dentist Advisors. We can point you in the right direction there. Or you can go to dentistadvisor.com/5.2 if you just want to set up a consultation with our tax team there. Mm-hmm. Okay, let's get into some of this educational content that we've been talking about today. We will start with student loans, which I want to preface this by saying, Lauren, this is a beefy topic in and of itself. Taylor and I did a webinar, like an hour-and-a-half webinar a couple of weeks ago on this. We are trying to keep this, like today, maybe the shorter version of this. We can kind of branch off in a few different directions. But let's inform the people of what they need to know, like brass tacks, some deadlines and things here. So I'll start, Lauren, then maybe you can pick up. I'll start with this slide and then maybe you can help me fill in some of the gaps that I'm missing here. So July 1st, which is a few weeks ago, it was a big date, which is when all of the new student loan initiatives that Trump put in place with the big, beautiful bill last year came into effect. So as of July 1st, the new RAP plan is available. RAP. I think people call it RAP, not RAP. But
RAP
I always
sounds
feel funny.
better.
I always feel funny saying RAP, whatever. This is essentially replacing this SAVE plan. Just a few details on this income-based repayment plan. If you were on the SAVE plan, it is very similar to the SAVE plan. There's a few tweaks. One of those tweaks is if you still have a balance after 30 years of payments on these loans, you will get forgiveness after 30 years. That is less favorable than the SAVE plan. The SAVE plan was 25 years. So this is extending your payments out for 5 years. The calculation of payments is also a little less favorable, where just the calculation they're using based on your income to figure out what your monthly payment is, it just essentially calculating your payment a little bit higher than what it was on the SAVE plan. But there still is any unpaid interest that you're not paying every single month will be canceled, which is nice.
With people that are signing up, I feel like I'm starting to have clients that are potentially going to go to RAP.
Yeah.
And when they're going through the process, I feel like there's lots of different information. Do you feel like your clients have been seeing like different payments than... Like I got on a call today and she had like 4 different payments, even for the standard repayment plan. They quoted her like a 240
really
instead of a 10-year. They gave her a 20-year under standard, and I was really confused by that.
Oh, wait, 20-year under standard?
Under standard, right? But standard is 10-year. Have you seen like any like thing like that come through where like the payments that I was calculating, I was like, these are not the same payments?
Okay, that's actually a great thing to bring up there, Lauren. So this actually plays into, I don't know if we have a slide about this, but other changes with the big beautiful bill is RAP was instituted and the SAVE plan is going away. They're also changing the standard repayment plan. So where it used to be like if you didn't elect for anything graduating out of school, you have your 6-month grace period, and then they would just default you in to the 6-month, into the 10-year standard repayment plan, right? Where you just pay back your loans over 10 years based on the interest rate of your loans. It was just basic and simple as that. Now they have changed that standard plan from 10 years to be either like 5, 10, 15, 20 years based on how big your loan balance is. So if you have over $100,000 of student loans, you will be on this 20-year plan.
That's good to know.
For most of our clients listening to this, you will be on the 20-year is actually the change there, which is actually beneficial to borrowers, where if you graduated and you have maybe like a 4% or a 5% rate on your standard loans and you don't want to refinance and you want to stay with those loans, a 20-year payback period will give you some lower payments at the beginning of your career to give you some more flexibility. So it actually is more beneficial, and you can always make extra payments down the road if you wanted to. But yes, so there's now, for most dentists with more than $100,000 of debt, you will be on a 20-year standard.
That's good to know. Yeah. See, I feel like I consider you and Taylor like the world's best student loan, the student loan guys.
Sure.
And new stuff is coming out all the time. It's so hard to keep up sometimes.
It is. We're hoping that these changes, like there won't be a ton of changes here in the next couple of years when we get a new administration, maybe in 2028. But as of now, I think these changes will be into effect for at least the next 2 years or so. So that's a great point. So the RAP plan came into play here as of July 1st. The new standard 20-year student loans for those over 100,000 came into play. There are a lot of people out there who still were, what's our next slide here? I might have to come back. We'll switch this. Who still were on the SAVE plan. If you were on the SAVE plan, it's likely you didn't have to make any loan payments over the past handful of years. You didn't have to recertify your income. How this is working is you will get an email from your servicer. You may have already gotten one. If not, they say you're going to be getting an email between now and possibly the end of the year, where you will have 90 days to get off of the SAVE plan. Old plans like Pay and ICR and even IDR are all going away. They're still old, the new IBR. So essentially moving forward, you will have like getting off of the SAVE. If you want to stay on an income-based repayment plan, you will have to be on old IBR or new IBR or RAP is what you want it to be elected to. It kind of simplifies things there, which is nice. When you switch off of these plans, you will have to recertify your income. When you have that 90-day window, getting off of SAVE, you'll have to recertify your income, which is where you go to studentaid.gov. It'll ask you for all of your information. You'll switch to a new plan. You'll have to resubmit your income. Use it like now they'll just tie it to your last reported tax return and pull your income from there. It'll give you a new calculated payment, and you can kind of pick from like those options, Lauren, that you were mentioning as you had a client go through it. There's so like here's your IBR payment, here's your RAP payment, here's your standard payment. It'll allow you to pick from some of those things there. Okay. Again, this is one of those things where I feel like I could branch off in a million different ways here if we wanted to. And I feel like I'm already over rambling and talking about this.
So you should go to the webinar that Jake and Taylor did because it's amazing. If you have more questions, ask your advisor.
Sure. It's a long one. But yes, that's a precursor to all this is please talk to us, reach out to us. This is like the general information. Please reach out to us if you have questions about your specific situation. But the big thing to note here is RAP's in play. If you are on SAVE, you are getting kicked off here in the next handful of months. Let's talk about if it makes sense to just refinance or move to old or new IBR. RAP doesn't make a ton of sense, Lauren, for most people because the forgiveness window is really long. If you're on RAP, qualifying payments don't factor into IBR or anything else there. RAP is really, I think, a good solution for newer graduates just starting out their career. They want to keep their payment low. They're probably going to refinance at some point in the future, but just want to keep as low a payment as possible in the short term. RAP probably makes sense for those people, but it is not awesome if you're still planning on going for a down the road forgiveness deal there.
Yeah. Totally.
Okay. Anything to add here, Lauren? Do we have another student loan here? Oh, this is Juno here. Anything on, did I miss anything? Did I overtalk on a few things? Okay.
No, I love it. Feels good.
Rabih, student loan question. You want to comment on student loans here?
I actually had one question. I don't know if we want to open the rabbit hole again.
Let's do it.
When you said the loan could be 5, 10, 15, or 20 years, right? Are they recalculating your interest rate as they do that shift, or what is happening with the actual rate that you're paying?
Not recalculating your interest. No, your interest is staying the same, just depending on what these terms are. So it's everyone who has student loans usually takes out loans each year, and each year you'll probably have a different rate depending on, say, like different loan tranches. They just take an aggregate of those interest rate amounts for your stated rates. But no, if you have like a 1-year repayment plan or 5-year, 10-year, or 20-year, the interest rate stays the same. It doesn't change there. I do think so. Our next slide here is kind of one of our partners is Juno.
I love them. I think they're great.
Who've done a great job.
They've done a great job.
Yes, if you're looking to refinance your loans, we have a guy named Joe as our contact over there who does, he's on top of it and will send out emails to you. We can make an introduction to Juno. If you're looking at refinance rates are pretty good right now.
Yeah.
You can get like under 5% over a 20-year period. Over a 20-year term if you're looking to go that route. So this makes sense for a lot of people. If you're kind of haven't been recertifying your income for the past handful of years, your practice has done really well. If you go to if you're getting bumped off the save plan now, there's a likelihood that your payment could jump up to be a few $1,000s a month. And it may make sense just to refinance, lower your rate, and pay less in interest here and pay your loans effectively. That makes sense for a lot of our clients. So anyway, we'd introduce you to Juno. It does a great job. Refinancing your student loans is a really competitive space. It's all done online. There's no closing costs or fees up front. There's places like SoFi or Earnest or Live Oak and places that will do it. They all have similar rates, but not a bad option right now, refinancing your loans. Okay, I think this is our last student loan slide. It is Trump accounts and Trump account strategy. I think we have quite a few slides on this actually, I don't think this will be a huge topic when we get into it. I've had a lot of questions about Trump accounts recently, which is great. We love questions about this. Let's just dive into some of the specifics of Trump accounts first, then we can get into maybe a strategy that could apply to you. So just on its face, what is it? Or maybe we should just go into how do you open a Trump account? First of all, let's do that.
The Trump app, right?
Yes. So this is a bit interesting. So how you open a Trump account is you cannot do it on a browser, which I don't know, there's probably a larger societal commentary to be had there, but you cannot get online and do it. You have to open up an app, sign up for an app just on the App Store. What's the app called, Lauren? This is called the Trump app?
I'm pretty sure it's called the Trump app.
Is what it's called, that you have to get on your phone. Once you download the app on your phone, you click into it, and it will ask you a bunch of your own information and then your child's information, who you'd want to set up the Trump account for. The custodian, the place where the accounts are held at, is actually Robinhood. They're using the Robinhood's platform in this Trump app to administer it. But that's how you set it up. It's as of July 4th, you can start setting up these Trump accounts. So in short, Trump accounts are accounts for minor children. You can open one up. You can contribute to it every single year. You can only do up to $5,000 a year. So there's a cap on what you can put in. There is no tax benefit up front when you're putting money into the Trump account. Is something important to know. So different from other types of kids accounts like a 529, there's not necessarily a federal tax deduction for a 529 contribution, but some states will offer a state tax deduction for you if you're doing a 529. Trump account is different. No tax deduction whatsoever going in. Once you put this up to $5,000 a year, the one caveat there that I have seen, we're already getting into the weeds of some strategies and things here. There is a $2,500 a year, an employer can contribute to the Trump account for you up to $2,500 per year, which is tax deductible to the employer. So if you're a practice owner out there, and if you wanted to, if you have kids on payroll and wanted to pay $2,500 to your kids on payroll through the practice, I guess there's a small tax deduction for you there if you wanted to. I don't rig the system, but that's a strategy that you can employ there. What's interesting about these Trump accounts is the money goes in, you can invest it. Another interesting, I feel like I'm saying interesting a lot, but another interesting thing about these accounts is it's just invested in an S&P 500 fund. You do not have options of where to invest this money. This is a U.S. account, so they're making you invest in U.S. companies. Not even the full broad U.S. market though, Rabih, just the S&P 500. I don't know, is it SPY? I don't think it's SPY. why, but it's another Fidelity fund. I think that, or not, Fidelity S&P 500 fund. I think they're using is what you're defaulted into. So that's something just to note. It's not a super diversified place to put your money, but it will be held in an S&P 500 fund. The money grows. Once they turn 18, the account essentially switches to a traditional IRA once your child turns 18, which is interesting because, again, I said interesting again there. I don't know why. That's just a word thing that I'm using today. All distributions, all the gain there are subject to ordinary income tax from that point on. In that sense, a Trump account is almost a tax disadvantaged account. It's almost like the worst tax account out there. For example, if you put money in a regular IRA, you're getting a tax deduction up front. You put $7,000 in for the year, you get to deduct that $7,000 on your taxes. When you do take it out, you do have to pay ordinary income, but the idea is I got the tax deduction up front, and I'll just defer and pay that later. A Roth account is the opposite, where you don't get a tax deduction up front, but you put money in and you do not have to pay taxes down the road. Even a brokerage account, where you don't get a tax deduction up front, but when you withdraw from it, you get favorable capital gains tax rates, which are 0, 15, or 20% on your gain. A Trump is the worst of all of those options, where you don't get a tax deduction up front and you pay ordinary income tax upon withdrawal, which is kind of crazy. I don't know why they structured it this way, or if there was some laws.
$3,000.
Yes.
For babies born, what is it, 2025?
I guess I buried the lead there. Yes, that is one benefit there, is if you've had a child born July 1st, 2025 until the end of 2028, you will get a free $1,000 deposited to you in your Trump account, which is great. I'm having a child here in like a week. Lauren is having a child here in a couple of months. Those kids will have if you set up a Trump account and apply for it, they'll get a free $1,000 deposited into their account. So if you have a child born in this 3-year window, you might as well open up a Trump account and take the free $1,000.
Download the app.
Outside of that, I do not know how useful these accounts are for like long-term kids planning. We will maybe get into some of the nuances and things here. Okay, so this is getting into putting kids on payroll, which we can talk about too. This is kind of a separate discussion. Like, this is a bonus education point here on top of just the Trump account. So I think this will apply to maybe a strategy that you can use with these Trump accounts. One of the low-hanging fruit, like easy tax deductions and strategies you can use for practice owners is you can put your kids on payroll at the practice. This, first and foremost, can be a tax benefit for you. Essentially, how this works is the standard deduction for 2026 for a single filer is $16,000 a year. The IRS says essentially, so if you make under $16,000 a year, the IRS says you don't even need to file a tax return. You're good. You do not owe any taxes on if you make less than that in a year. So you can put a kid on payroll, pay them up to $16,000. You do not have to file a tax return for them, and all that money goes through to them completely tax-free. This is awesome. If you have a few kids, you can this is essentially the equivalent of making 401k contributions, where you can essentially pay your kids, have that be income deferred from you, tax-free. You can use this for your kids, like expenses you're going to use for your kids anyway, whether that's like travel, vacations, sports, stuff that they were doing. You can use these funds to pay for them.
So do these have to go into like their own accounts, or can it still go into your account? What's like the nuance of that? Of like,
great question. This is where we defer to your accountant of what they feel most comfortable with. Every account is a little bit different here. I have clients who just take this money, they'll put their kids on payroll, and they'll just reroute this to their normal personal checking account, is where this money will go into.
I feel like I see both, so I was
yeah, you will also see some accountants will be like, well, to really like pass the sniff test of an audit for the IRS, let's set up checking accounts for your kids and move money into there. Great. Thanks for bringing that up, Lauren. That's like, depends on your accountant and what they want to do. And sometimes accountants will be like, if you have a 1-year-old, your accountant may not feel super comfortable paying them $16,000 in a year to a 1-year-old. It's hard to justify maybe to the IRS. So maybe they'll say, wait till your kid is 5, or maybe let's pay your kid $8,000 instead of 16. This is a joint conversation with your accountant to figure out what's most appropriate, for doing this. But this is a great like tax strategy you can use to help defer on some taxes, and use some money that you're paying for your kids anyway. The reason we bring this up is it kind of plays into a strategy for this Trump account. So you can use that money paid to your kids just for like stuff that they need. But if you didn't want to do that, what you can also do is move some of that money to a minor Roth IRA. So in order to contribute to a minor Roth IRA, you have to have earned income. So one of the benefits of putting your kids on payroll is that gets them earned income for the year, and they're eligible then to contribute to their account. Minor Roth IRAs function essentially exactly the same as a normal IRA, Roth IRA that you contribute to. Put money in, don't get a tax deduction up front, but you kind of do. You're contributing with dollars that weren't even taxed. You put money into the Roth IRA, that money grows tax deferred until you can take the money out when they're 59.5. The cool thing about minor Roth IRA accounts is if you set one up for your kids who's 5 and they have like a 60-year compounding time horizon until they want to retire, the numbers get pretty bonkers. Like the compounding effect there. Like if you have $20,000, $30,000 for a kid who's 18 and just let that sit for 50 years, the numbers get pretty crazy. So this is a cool, again, just like tax savings, kids like kickstarting their retirement strategy that you could use for them. One quick note on minor Roth IRAs, if you're thinking about this, is once they turn 18 or 21, depending on the state that you're in, that IRA does become, you have to sign it over to them and their authority completely. So make sure you have a conversation with them. Like, hey, if you have $70,000 in an IRA that I'm giving to you, tell you, like, you'd hope that your kid doesn't liquidate the whole thing and buys a car or something.
Yeah, that looks nice at 19.
Like, oh, this is very cool. I can go just have a blast with my friends with this money. But hopefully, other conversation. If I started this for you, I want you to keep contributing to this for your retirement in the future. Anyway, this is like, I feel like a long detour. Sorry to the listeners here of like getting back to the Trump accounts here. Is one strategy you could employ for the Trump accounts is because this account turns to an IRA when they're 18, there is the thought of you can roll that money over to a Roth IRA once they turn 18. The idea there would be at 18 or 19 or 20, the kids are in a low tax bracket. You can roll this, pre-tax money over into the Roth IRA and boost up their Roth IRA accounts and keep that growing for them in the future. This is a viable strategy if you wanted to employ it. I would do doing minor Roth IRAs first is like kind of easier and simpler way to max it out. If you wanted to contribute more, then like more Roth dollars to them, you could add in the Trump account contributions and roll it over there. I think, do we have kiddie tax here on the next one? Here's how it's showing how it plays out. Yeah, birth to 17, Trump account at 18, convert to a Roth, and then 18 on. Essentially, you have decades of tax-free growth and withdrawals there. One thing to note is if you're rolling this money over and when they're like between 18 or 25, you may be subject to kiddie tax is what it's called. Again, we're getting deep in the weeds here, guys. I'm sorry, but essentially, if you are still providing, they're independent of yours and you're still providing more than 50% of like their, what's the wording, Lauren? I forget, like more than 50% of their like food and shelter and like their care. Yeah, like more than 50% of like financial care for them. Even if they move this money over and if they're not making any money, that rollover would be subject to your own tax rate. Which is what the kiddie tax is called there, like anything above $2,700. So any of that like rollover they have to pay taxes on would be subject to your own tax rate, which could be pretty high. This could disincentivize you rolling money over when they're like 18, 19, 20. After 25, this doesn't apply. So they could also just roll money over 25 if they're in a low tax bracket at that point. Anyway, this is like, Trump accounts are weird. They're not super favorable tax-wise, but the one use case could be put money in, roll it over to a Roth once they're like 18 to 25 or maybe even like 25 to 26. I could see that as a use case for it.
Get the $1,000 if you're having a kid.
Take the $1,000, yeah, if you want it there. Anything to add here, Rabih, Lauren? No?
Aside from the $1,000, why would this be better than just opening a minor Roth IRA to start with?
It would not be. I'd prefer the minor Roth IRA to start. Okay. Thanks for clarifying. Like I would do minor Roth IRAs first. This could be like if you just wanted more Roth dollars for them on top of the minor Roth IRA for like, hey, we're doing this $7,500 a year. I actually want to do an extra $5,000 a year and roll this over to Roth. If you just really wanted to boost Roth money for them.
I feel like I'm still learning more about this too. So like if the kids are on payroll and they're using their payroll dollars, even though technically it's after tax, the tax is zero going in.
Mm-hmm. Which is kind of the benefit of the Roth IRAs is like the money going into the Roth actually was not taxed and you're getting tax-free growth here on out. So that money technically never touches tax.
For Roth and for the Trump account? Would the Trump account be zero too because the kids are at zero?
Exactly. If you're using those funds there. Mm-hmm. Yep. So that's the benefit of having the kids on payroll and paying them out of the $16,000 there. Okay, here's more. This is just if we didn't explain it thoroughly or if this maybe a visual aid helps people understand the flow here.
And you've got your compounding numbers right after, which is kind of nice.
And then we get compounding right here,
bonkers
which is
numbers.
They are bonkers. Yeah, I'm a big fan of minor Roth IRAs for kids. If you can do it, if you own your own business and can't put them on payroll, maybe even more than like education funding. Like I think it's really cool to set up a Roth IRA for a kid account and essentially start prepping for their retirement when they're 5 years old. I think it's pretty awesome. So that's how that goes. Talk to your advisor about this more in depth if it's something you're thinking about doing. Setting up kids' legacy. Okay, Rabih. Let's get to what everyone is waiting for here. Let's get me stop talking a little bit if I can. And let's get into some like economy, what happened over Q2. I turn the time over to you.
I'm going to keep it short because I promised people it'll end in 15 minutes on 2x speed and we're over that already.
Okay, let's go.
But if you guys look at this chart,
a lot of green.
We're in a bull market and
Sheesh.
Bull markets last for a long time. So get used to such a picture, famous last words. But if you look at the return for the last year, we've got 22% growth in US stock market. And this is between end of June 2025 and end of June 2026. 22% for the US stocks, 20% for developed markets, 43% for emerging markets,
Insane.
15% for real estate, and like 4 to 3% for bonds across the board. So the story is AI and the global AI infrastructure. There are some blips and bumps along the road, such as geopolitical tension, wars, oil price shocks, etc. But those are not the main theme. The main theme has been the new technology across the board. Every single country that has a technology sector is benefiting from that wave. So looking at this portfolio and seeing, for example, the emerging markets have doubled the performance of international and US markets, from our perspective, this raises one main issue to look at. We love the returns, but the issue that this raises is how are we going to be keeping the portfolios in balance, right? Rebalancing comes bigger into this equation when you have one asset class outperforming the others in magnitude. So if we go to the next picture, Jake, you can notice that diversification is very important, and it's not only important in the US. This chart over here shows you what in each region, US, emerging markets, Eurozone, and Japan, what are the 10 largest companies in that region. In the US, we've got our Max 7 and a bunch other. We've got NVIDIA, Apple, Microsoft, Broadcom, Micron, Alphabet, Meta, Amazon, Tesla, and Eli Lilly, right? So these are the 10 largest companies in the US, and they are 24.4 trillion dollars in market value. They are equal to 38% of the index.
Bonkers, yeah.
This is the concern of diversification. Is like, are we getting concentrated in more companies? 10 companies hold 38% of the size of the US market. So when it comes to diversification, not only are we interested in diversification across the different regimes, like US versus developed versus emerging, we are also interested in diversification levels within each country. We just did a 2 cents episode, right? Where we saw that Max 7 hasn't been performing well. These are the Max 7. This is an indicator of a healthy market, and we'll see it in a second. But when it comes to this diversification question, we know we're worried about the US, but the US is not the biggest diversification worry for us. The biggest diversification worry for us is emerging markets. If you look at the top 10 companies, you've got 3 of them that are already 32% of the size of that market. You've got TSMC in Taiwan, you've got Samsung Electronics in South Korea, and I think I'm not sure where SK Hynix is the domicile country of, but it's also in Southeast Asia. Type of vibe. So what is happening here is that, and if you look at the whole Taiwanese stock market return, it's dominated by TSMC. If you look at the whole Korean stock market return, it's dominated by Samsung. They only have one company for their their stock market. And the question would be here, those companies have become so big in their countries that they're now dominating the emerging market sector. Any company-specific risk will reflect immediately in a drawdown in emerging markets. So while emerging markets went up 45% for the last year, this does not mean that we should double down and increase exposure in emerging markets. On the contrary, simply because if the US goes up 40%, we would be more comfortable than emerging going up 45%, simply because the US has more companies in its top 10 than emerging does. So diversification is still very important. There are some big winners. I think the main key takeaway here is that do not over-concentrate chasing winners and make sure diversification is still on the table, especially in an environment like this. This is what we're doing at Dentist Advisors right now. The next slide would be about how the markets are actually healthy. So on the left-hand side, you can see like the subsectors that are driving the AI revolution. We've got hyperscalers, we've got semiconductors, we've got hardware, we've got power, and we've got software. These are different companies favor these, and these are what is driving return. Each bar from the least shaded to the most shaded shows you the return of that sub-industry by year. So for example, for hyperscalers in 2023, they made 70% return. In 2026, on the other hand, they are down 5%. Similarly, software, we've been seeing the sell-off in tech and NASDAQ from software to AI companies. In 2023, they made 56%, followed by 15%, 11%, 2024, 2025. 2026, this software is down 20%. So what you're seeing is that this big AI wave is actually composed of smaller waves within the sub-industries. And if you want to win the AI race, you probably have to buy all of them. A lot of people were jumping after semiconductors, which is true, because in 2023, they made 98%, and now in 2026, they're up 46%. Think of SanDisk, think of Micron. Those are the semiconductors. They hold memory. But on the right-hand side of that chart, look at their valuations. This is the next 12-month PE ratios. Hyperscalers and softwares, their last bar, their most shaded bar, they are having a losing year, but their valuations are in like the 28 PE and the 19 PE. Those are normal valuations, even if they are losing money. Whereas if you look at semiconductors, yep, they're up 46% for the year, but their valuation is 103. So within what is happening, we're getting smaller booms and busts within the AI sector itself. And this is healthy if you are diversified. This is terrible if you're concentrated in one company and you're like following Micron or SanDisk or Snowflake or going after NVIDIA all in. So yes, we're all going to be, AI is going to make everyone a winner at the end. The mistake would be to get stuck in one company versus the rest. This brings us to how this boom and bust translates onto the bigger level, which is the big chart on the right-hand side. This is the Magnificent Seven performance in the S&P. In 2025, for example, the S&P 500 returned 16%. The Mag 7 contributed 23%, and the S&P 493, like the remaining companies, were 13% of that return. So the S&P 500 would be the average of these two numbers, right? In 2026, S&P 500 is up 10% year to date. Mag 7 did not make any money this year, but the remaining 493 companies are up 15%. So they're kind of, if you average them according to the appropriate weight, that puts you at 10%. What this tells us that the Mag 7 is not going anywhere because of the boom and bust within the AI subsectors. But for the last couple of years, the Mag 7 has been driving the market up forward. And now it's time for the rest of the market to catch up. This kind of sustains the idea that the rally that we saw in the Mag 7 in the last couple of years was not a bubble as much as they are pushing the envelope, paving the way. And now it's up to the market to validate whether those are the new levels of the market, price levels of the market. So when we're doing this, a bunch of companies have significant return, they drive the market up, and then they sell off at the expense of others following them back. This is a very healthy indicator of the market. This is just a feature of how the bull market rotates within itself. So keeping that in mind, keeping in mind that we're seeing green across the board, our job is not to get our portfolios concentrated as a result of this mechanism in the market. So diversification is at play, and we're letting the market run with its gains.
Yeah, I think that's awesome. Essentially, yeah, like the S&P 493 is catching up. We're seeing returns from other places in the market and not just the Mag 7, which again, like you said, Rabih, is really healthy.
Yes.
Okay. We went way longer than I thought we would, which is fine. We're giving you great information here. We can wrap this up. Lauren, final thoughts, if you have any.
No.
Okay.
No, I don't have any.
Okay. Rabih, you're good too?
We're good.
Okay. Thank you all for being clients. We love working with you. We will see you again next quarter. Thanks for tuning in. Talk to you later.
Thank you. See you.